Zacks Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. Now we're going to talk about ratio back call spreads. I have no idea what this is, but Kevin Matris does, and he's our options guru here. He's going to try and explain all of this to us. I guess on this one we're going to need to start right from the beginning.
Yes.
I don't know what you're talking about, so I will rely on you
right.
to fill in the blanks.
All right. So first off, ratio back call spreads. It's interesting because this is a strategy that seldom people ever talk about. A lot of people have never even heard about it, but it really is an interesting strategy, and it is a great way to position yourself in a trade if you believe something big is going to take place. And I think it's an opportune way to be able to really try and maximize your potential return while at the same time lowering your cost of entry. Now you can even put this kind of strategy on as a credit. So you can do it as a debit or a credit. But today we're going to focus on the more traditional way of putting this on, which is a debit. You're actually investing something, paying something. And we're going to go over how you would place this trade. But again, I do want to say that this is a strategy that really works best when you are expecting something big to take place.
All right. How exactly does it work? And speak slowly because it takes me a while.
Yeah, I got a lot of notes here, but check it out. Let's say that you are looking at a particular stock, and let's say it was trading at $135, all right? Let's also assume that you're going to be putting on an out-of-the-money back call spread with 4 months of time on it. So check this out. When you're doing these ratio back call spreads, you're going to be selling one out-of-the-money call, and for this example, let's say that we are selling the 140 call at 11.25. You're also going to be buying two further out-of-the-money calls, and for this example, let's say that we're going to be doing the 150 calls for $7.50 each, or a total of 15, right? So on the one that you wrote, you're collecting a premium, you're collecting $1,125. On the two that you bought, you're going to be paying a premium. So if you collected $1,125 and you paid $1,500, your net cost or your net investment is going to be $375 to place this trade.
With you so far, I think.
Okay, next. Let's say that the one I wrote had a delta of 0.5 or 50, right, 50%, and the two that I bought each had a delta of 0.39 for a total of 0.78. So what is my position's net delta? Here's what it is. If the ones that I purchased are gaining 0.78 of the underlying stock's move, but my written call is losing 0.5 of the stock's move, my net delta is 28%, 0.28, 28 or 28%. So that means at the beginning, for every dollar rise, my position will gain in value 28% of that.
Okay.
Why would I do this? Here's why. For one, my cost is only $375. If I were to do, let's say, a regular call buy for that price, right around $375, $400, I'd have to go all the way out to the 165 calls, and I would likely get an even smaller delta, which means I'd be profiting more slowly. But the real reason why you would want to do this is because, for one, it's a cheaper way to get into the position, but you're really hoping to capitalize on an increase in delta, which means ultimately you're going to see an accelerated increase in the value of this position if, in fact, a big move occurs. So, for instance, the 150 calls, or the 150 calls I bought in this example, are $15 out of the money, and they have a delta of 0.39 each. The 165 call by comparison is actually $30 out of the money, and that would have a delta of, let's say, right around 0.24. However, as the stock moves up, the closer strikes will see their delta increase more so than the ones that are further out. So for example, let's say now the stock went from 135 up to 150.
Yep.
The 140 call would likely see its delta increase to 0.70 or 70%, right? The two 150 calls that I had purchased, those would now probably have a delta of 0.58 for a total of 1.16. So, or 116% of the future, right? Or the underlying stock, 1.16. So, if I had 1.16 minus the 70, that means my net delta is a positive 46. And my back call spread would have more than likely doubled by the time that happened. So once again, let me just say this. If in fact the stock moved up, the one that I wrote had increased in value, the delta, and the two that I had purchased also increased in delta. That delta on the one I wrote probably would have gone up to 70.70. And the two that I purchased, the combined delta would have been 1.16. So once again, 1.16 minus the 0.7, that is how I get my net delta of that 0.46. However, that 165 call by comparison would likely have only seen its delta increase to 0.38. So I would have made more money on that ratio back call spread. And the thing that's interesting is that as the stock continues to climb, those calls that I had purchased, they're now at the money, they're now going to be getting in the money, and those options are going to accelerate in premium. You're going to see them grow faster, and the delta is going to grow faster as well. So this is a way for me to truly leverage myself and maximize my opportunity if in fact I see something really big taking place.
Is there a downside to this?
Yes, there is a downside. The downside is this. At expiration, if the option that I wrote is in the money, right, that 140 call, don't forget, that is the part of the trade that's kind of working against us, if you will. I'm going to be losing on that end. So if the ones that I bought are also out of the money or even at the money, I've lost the full value on those. So check it out. If I collected 1125 on the 140 call, that call option at expiration is actually now worth $1,000. It's $10 in the money. So I've actually still made $125 on that position, but another way of looking at that is that I actually gave up, in a sense, $1,000 of premium that I had expected to collect in the first place. On those two 150 calls that I bought, I've lost the entire value because they are out of the money. So I've lost the entire $1,500. So if I lost $1,500, but I made $125, my net loss is actually $1,375. So you can lose on this type of positioning if in fact your options expire. The ones that you purchased are out of the money and the ones that you wrote are in the money. That is where you're going to see your maximum exposure. Alternatively, though, if the back call spread was in the money at expiration, then I'm okay. And in general, if let's say my spread is $10 wide, I'm going to need to see the stock get at least $10 above the options that I purchased in order for me to be okay. So you want to have the ones that you bought be at least $10 in the money or whatever size that spread is. But again, the way to really make this trade work is not to sit in there until expiration. I believe the way to make this trade work is to get in and get out while there is still plenty of time or time value left. So if you're looking for this trade, you're really looking for options that have an increased volatility. You're expecting to see a big move, and you're really expecting to take advantage of a pretty big increase in the expansion of the delta. That is how you're going to be able to make your money, and by utilizing this strategy, you're really figuring out a way to get into this stuff at a much cheaper price. Now, it is a ratio, so you can do 3 to 1. You could buy 3 out of the money options, and that would even increase your profitability even more, but of course, you're taking on greater risk.
It's one of those strategies that is interesting, but you really need to take some time with it to fully understand it.
Right. You know, I would say, we did our best to try to explain this on video. If you want to really get into this thing in more detail, look at the article, because sometimes you have to read this stuff and look at the numbers at the same time to really understand what's happening. These things are really not as complex as they may seem at first. They're actually quite easy to understand, but you really have to know what you're looking at. And what's cool is that we have a free book on the website, a free booklet that really explains how these different option strategies work. And we're pretty excited too because we even have some training programs which can kind of teach people how these strategies work and how they can employ them in their own portfolio.
All right, so if you go to Zacks.com's homepage, if you're accessing this video from outside of Zacks.com, and you scroll down the homepage till you get to the options section there, you'll see by clicking on the headline associated with the video that it will take you to a text version of this article. And that may be something that helps you. The booklet, the text version of the article, just ways that Kevin has prepared so that you may know your options. With Kevin Matris, I'm Terry Ruffalo.